So with that, it's my pleasure to next introduce my boss, Jim Bullard, where's our Minnesota commissioner? Minnesota folks, raise your hand so I can see where you are. Well, if you're somewhere here, what? Left? No. Anyway, I was going to say Jim's a native of Forest Lake, Minnesota. I thought that would be of interest to you. But obviously, in his bio, in the back of your book, has a well-established academic record. And of course, his many contributions to the Federal Open Market Committee have been noted far and wide. More than that, though, Jim sets a tone here at the Federal Reserve Bank of St. Louis that makes it a great place to work. Dare I say, we were in one of the top workplaces in St. Louis again this year. We're very proud of that. But it is an environment where we're encouraged to grow, explore, innovate, and simply to try things that maybe traditionally haven't been some of the things the Federal Reserve would try. We appreciate that, Jim. And with that, I welcome you to the podium.
Well, thanks very much, Julie. I have and welcome to all of you. I have a few prepared remarks. I'm pleased to welcome everyone to the Federal Reserve Bank of St. Louis for the 6th Annual Community Banking Research and Policy Conference. I'm also pleased to welcome the FDIC as an official conference sponsor starting this year. The Federal Reserve and the FDIC work closely with state banking regulatory authorities to supervise our nation's state-chartered banks, the vast majority of which are community banks. Due to this shared supervisory role, the Fed, CSBS, and FDIC have mutual interests in understanding the opportunities and challenges facing community banks and in promoting quality academic research that helps inform decisions that affect the industry. Today we are looking at a somewhat different set of opportunities and challenges than when this conference was first launched in 2013. Regulatory burden and the potential impacts of the Dodd-Frank Act dominated the discussion during the first few years of the conference. Although those concerns over regulatory burden are still on the minds of community bankers, attention is shifting to the opportunities and challenges posed by technology. On some level, these concerns aren't new. Banks have always had to keep current with the latest technological innovations impacting their industry. But the pace of change and growing cyber threat environment have accelerated the impact as a number of new financial technology firms seems to be increasing rapidly. As new financial technology offerings entered the marketplace, we heard regular assertions that fintechs would disrupt the financial services industry or perhaps even replace it. Bold statements were frequent. Fintech firms were going to upend relationship lending. They will provide unprecedented credit access to the underserved. Fintech will make branch banking obsolete. To date, those assertions have not been fulfilled. Instead, we have seen significant cooperation between fintech firms and financial institutions because of their mutual interests. And importantly, because fintech firms have largely relied on banks to clear and settle their transactions. We are aware of many successful and responsible partnerships. For the most part, these partnerships work well, allowing banks to offer products and services that may have been out of reach previously or engage new customers and new markets that had previously been closed to them. I understand we will close this year's conference with a panel that will specifically explore the future of community banking through the lens of those who have suggested these types of partnerships. These partnerships, of course, are not without risk. Increasingly, we are hearing stories of fintech companies interested in their own financial services charters, special purpose charters, industrial loan company charters, or traditional bank charters. While traditional bank charters provide a level playing field in terms of the regulatory and supervisory process, the options and opportunities with other forms of charters are yet unknown. For those banks partnering with fintech firms or using their services, there is also some degree of uncertainty. I mentioned cyber risk earlier. We are very cognizant of the potential for growing interconnectivity in our financial system. I anticipate that operational risk will someday equal or exceed credit risk for many community banks. We also recognize the uncertainty of the impact of the use of artificial intelligence on the underwriting of credit and its impact on financial markets during economic cycles. Providers of these services must be vigilant about providing fair and equal access to credit. There must be mechanisms to ensure credit availability even during stressed economic cycles. One of the lessons learned from the financial crisis was that the volume of small business loans fell substantially in larger banking organizations. This was often not due to liquidity or capital issues. Indeed, it is possible that automated underwriting mechanisms were an important contributing factor. The changing landscape of financial services is an important reason for this conference. The impacts of automation on the financial services industry have been substantial in recent years, and the pace of change will likely only increase. Across the country, cities are making investments in technology incubators to improve the efficiency of common business processes. In the St. Louis Feds District, we have examples of these technology and innovation hubs, including Cortex and T-Rex, innovation communities in St. Louis, and the Little Rock Technology Park in Little Rock, Arkansas, which are enabling innovation in several industry sectors. Perhaps our innovations will be the topic of a future conference. In closing, I want to thank you all, our in-person and webcast audience, for your participation in this year's event. It is your ideas, your questioning, your debating, and your engagement that make this conference what it is and enable it to have the impact that it has had. So thanks very much.